Hi, I'm Kevin Learned, one of the partners with Sage Growth Capital. What options does an entrepreneur have to finance his or her business? Well, they're really selling stock in the business is option number one. Borrowing money is option number two. Obtaining grants and sometimes for young students that may be in college, awards from entrepreneurial competitions, maybe a third option. The fourth option then is revenue-based capital. So who is revenue-based financing best for? It's appropriate for two types of companies. Let's take the company that has sold equity and they expect to have a classic exit at some point in time. That still may be appropriate to take down some revenue-based capital because we're non-dilutive. In this situation, where it works best is the company is started, they've raised some capital, they have their product, they brought it to market, and now they need additional cash to put into marketing to bring the product to the market or to accelerate the growth of the product. So the number one use of revenue-based capital is to provide growth capital to accelerate the growth of the product that the company has brought to the marketplace. Another use is for companies that are what we might call Main Street businesses. These are companies, often family businesses, maybe pretty good sized, but they don't expect to ever have an exit. And therefore, availing themselves of the equity market really isn't open to them. If there's not going to be an exit, you're not going to be able to raise equity capital typically because equity investors have to know how they're going to get their money back sometime. So a company that expects to stay in business for a long period of time without ever selling to another company, they may be appropriate for deploying revenue-based capital. Again, the capital is best deployed to grow the sales of the company. Revenue-based capital offers several advantages over equity capital. The first, of course, is it's non-dilutive. Legally, it is a loan. We don't share in the equity ownership of the company. Once the revenue-based capital is retired, the investor has no more interest in the business. That is perhaps the most compelling argument for deploying this capital. But there are others. Revenue-based capital is fairly quick to secure if you qualify for it. In our case at Sage, from the time a company applies until the time we disperse can be as short as 4 to 6 weeks. We don't have to do the diligence that equity investors have to do in terms of valuing the company or in terms of its exit strategy. That shortens it. We only invest in post-revenue companies. That shortens the period of time. So we can usually respond quite a bit faster. Third, the way revenue-based capital is paid back is as a percentage of the revenues of the company each month. And when it is properly deployed to increase sales, the sales go up from the deployment of our capital. There's margin off those sales. That margin will more than service the note that you have to us and provide free cash flow to the business. So it's a much more effective way of financing growth for businesses than selling equity. And by the way, we also don't ask for collateral. We don't ask for guarantees. So to that extent, we're much friendlier than traditional type of debt.